you're a real estate investor, here's something most people don't realize until it's too late. Most audits don't happen because someone did something illegal. They happen because something doesn't look right on paper. And many investors unknowingly raise red flags for years until the IRS finally decides to take a closer look. So today I'm going to walk you through the most common IRS audit red flags that I see for real estate investors and how to stay off the radar legally and ethically. Before we get into red flags, let me quickly introduce myself so you understand where this perspective is coming from. My name is Lisa Marie Odeja. I'm a CPA and an Enrolled Agent, and I specialize in advanced tax strategy for real estate investors. However, these concepts also apply to established business owners. However, my niche is real estate. Previously, I worked as a federal government auditor, and it trained me how to think like a reviewer, focusing on documentation, consistency, and how positions are evaluated, not just how to prepare a return. Now, this combination matters because good tax strategy isn't about pushing limits. It's about making sure what you do makes sense to someone else who reviews it. Red flag number 1, losses that never turn around. One of the fastest ways to attract attention is reporting losses year after year with no clear path to profitability. Now, losses can be legitimate, especially when there's depreciation. But when they continue indefinitely without documentation or strategy behind them, that's when questions start. What matters is intent and structure, and not just the numbers. Red flag number 2, when personal and rental expenses are mixed together. This is one I see constantly. When personal and rental expenses run through the same account without any clear separation, it makes it very difficult to defend deductions. Even if expenses are valid, poor bookkeeping can make a clean return look sloppy, and sloppy attracts scrutiny. Red flag number 3, aggressive real estate professional claims. Claiming real estate professional status can be powerful. However, it is heavily scrutinized. When your hours, activity, and documentation don't align, it is one of the fastest ways to invite an IRS audit. The strategy itself is not the problem. Poor execution is. Red flag number 4, large one-time deductions without support. Cost segregation, repairs, large write-offs can all be legitimate. But when large deductions appear suddenly without clear explanation or documentation, that's when the return stands out. The IRS doesn't just look at what you deducted. They look at why it makes sense in context. Red flag number 5. Inconsistent reporting year to year. Big swings in income, expenses, or classifications without a clear reason is another trigger. Consistency matters. And when things change, the return should tell a logical story. Here's the important takeaway. Most audits don't start with suspicion. They start with confusion. And good tax strategy is about clarity, documentation, and alignment, not being aggressive or flashy. If you're a real estate investor and you're not sure whether your current tax strategy would stand up under review, that's worth addressing sooner rather than later. You don't need fear. You need structure. If you found this video useful, you can find a link to my website in the description below, where you can find out more about how I work with real estate investors and business owners. And also, if this content was useful to you, make sure you subscribe, and that way you won't miss future videos. Thanks for watching, and I'll see you in the next video.